global financial system often feels invisible. Money moves through digital pathways, transactions happen in moments, and markets open and close with such routine precision that most people rarely question what holds it all together. Yet beneath that steady rhythm lies a delicate structure built on trust, timing, and coordination across continents. And history has shown that when those elements are shaken, the effects can spread faster than anyone expects. Imagine waking up to headlines suggesting that major banks across different regions are facing unexpected strain. Stock markets open with uncertainty instead of confidence. Traders begin speaking in cautious tones. In a world where finance connects nearly every industry, even the suggestion of instability can travel quickly through investment funds, corporate operations, and everyday savings accounts. Financial systems are designed to appear stable, but stability often depends on continuous confidence. Every deposit placed in a bank, every transaction approved through a payment network, and every investment traded on a stock exchange relies on the belief that institutions will honor their commitments. When that belief weakens, even slightly, the ripple effect can spread across global markets. To understand how a short window of time could threaten such a massive structure, it helps to look at how modern finance operates. It is a network where banks lend to one another across borders, corporations rely on credit lines issued from multiple regions, and investment firms allocate funds across international markets. This interdependence has created enormous efficiency and growth, but it has also introduced vulnerability. Consider the role of liquidity. Liquidity refers to how easily it flows smoothly through markets. Banks can access funds, companies can finance operations, and investors can buy or sell assets without hesitation. However, when uncertainty appears, institutions may suddenly hold onto their cash reserves, waiting for clarity. That hesitation alone can slow the financial bloodstream. According to available information from past economic events, liquidity shortages have often played a central role in financial crises. When institutions hesitate to lend to one another, even highly stable organizations can struggle to meet short-term obligations. If financial institutions cannot access funds when they need them, confidence begins to weaken across the system. Another critical factor lies within the interconnected web of derivatives and financial contracts. These agreements allow companies and investors to manage risk, stabilize pricing, and hedge against unexpected market swings. While these instruments are essential tools in modern finance, they also create complex chains of obligation. Public speculation often focuses on the size of large financial institutions and whether they are considered too significant to fail. While regulators have introduced safeguards intended to reduce systemic risk, the reality is that global finance remains deeply interconnected. Even smaller institutions can trigger broader consequences if their operations link into critical payment systems or investment networks. The role of technology adds another layer of both strength and vulnerability. Automated systems can execute large volumes of transactions within moments, improving efficiency, but also accelerating market reactions. If panic begins to spread, automated trading algorithms may amplify volatility by responding to rapid price changes in ways that reinforce market movement rather than calming it. Now imagine a scenario where multiple pressures begin to emerge at the same time. Investors might shift assets towards safer options. Currency markets could react as traders reassess economic stability. At first, central banks and financial regulators would likely monitor the situation carefully. Their role is to provide stability through policy tools, liquidity support, and clear communication. However, timing becomes critical. Financial systems rely heavily on perception. Even if underlying fundamentals remain strong, fear can create a self-reinforcing cycle. If depositors believe a bank may struggle, they may withdraw funds preemptively. That action alone can create the pressure they feared. Similarly, investors might sell assets not because of confirmed risk, but because they expect others to do the same. Initial concern grows into uncertainty. Uncertainty evolves into widespread caution, and caution, if left unchecked, can transform into coordinated withdrawal from risk. The transition can happen rapidly, especially in a digital era where information spreads across social platforms, financial news outlets, and private investment networks almost instantly. Now pause and consider this question. What happens when multiple markets experience uncertainty simultaneously? When stock markets, bond markets, and currency exchanges all react to shifting confidence, the effect can multiply. Companies may delay expansion plans. Governments may face higher borrowing costs. Consumers may reduce spending due to economic uncertainty. These behavioral shifts can extend financial stress into the broader economy. This is where the narrative takes a deeper turn, and where many experts suggest the greatest risks often hide. Modern financial markets operate continuously across global time zones. When one major market closes, another opens. This creates near constant trading activity. While this connectivity allows rapid recovery in stable conditions, it can also spread volatility across regions without pause. A disturbance that begins during trading in one financial hub can influence investor sentiment as markets open elsewhere. Some reports suggest that the speed of information flow in the digital era has transformed how financial events unfold. In earlier decades, market participants relied heavily on scheduled reports, official announcements, and traditional media coverage. Today, investor sentiment can shift based on real-time commentary, analyst speculation, and rapid social discussion. Central banks remain a cornerstone of financial stability. They can inject liquidity into markets, coordinate with international partners, and reassure institutions through policy actions. However, their effectiveness often depends on public confidence. Clear communication can calm markets, but mixed signals or delayed responses may allow uncertainty to expand. Picture a moment when financial leaders across different continents hold emergency meetings. Analysts broadcast urgent updates, and investors around the world refresh market data continuously, waiting for signs of stabilization. In that narrow window of time, the decisions made by regulators, institutions, and market participants could determine whether confidence returns or whether uncertainty deepens into something far more disruptive. Another layer of vulnerability lies within corporate supply chains. Many global companies rely on short-term financing to manage inventory, payroll, and operational costs. This pressure can move quickly from financial institutions into manufacturing, transportation, and consumer services, demonstrating how deeply finance connects to everyday life. Government responses also play a crucial role. Policymakers must balance stabilizing financial markets with protecting long-term economic health. Emergency measures can restore short-term confidence, but they may introduce political or economic debates about sustainability, fiscal responsibility, and regulatory oversight. These discussions often unfold in real time, while markets react to each development. Safeguards such as stress testing, capital requirements, and coordinated international regulation aim to reduce the likelihood of widespread collapse. Many economists highlight that lessons from previous crises have strengthened institutional resilience. However, resilience does not eliminate risk entirely. Complex systems can still experience unexpected pressure points. Trust encourages investment, supports lending, and allows economies to grow. This is why transparency, communication, and coordination remain essential tools during periods of uncertainty. As financial historians often note, crises rarely emerge from a single cause. They tend to develop from overlapping pressures, gradual imbalances, and sudden triggers that expose underlying vulnerabilities. The challenge lies in recognizing those warning signals early enough to respond effectively. Now consider the emotional dimension of financial stability. Behind every market index and institutional balance sheet are individuals managing retirement savings, business investments, and long-term financial security. The psychological impact of financial uncertainty can influence behavior just as strongly as economic data. Consumer confidence, investment appetite, and corporate planning often shift based on perception as much as reality. In a scenario where global markets face intense pressure within a short period, international cooperation becomes essential. Financial leaders frequently coordinate through multinational organizations and cross-border regulatory partnerships. Shared information, aligned policy responses, and synchronized communication can help prevent isolated challenges from becoming global emergencies. Yet cooperation itself requires trust among nations, institutions, and investors. Differences in economic priorities, political strategies, and regulatory frameworks can complicate unified responses. Maintaining global financial stability often depends on balancing national interests with collective economic security. As this hypothetical window of time unfolds, the world would watch closely. Analysts would examine liquidity indicators, market volatility, and institutional announcements. Investors would evaluate risk exposure. Governments would assess economic safeguards. And ordinary individuals might check their financial accounts, wondering whether stability will return. Financial markets have demonstrated remarkable resilience throughout history. Many periods of severe stress have eventually led to regulatory improvements, stronger safeguards, and deeper understanding of systemic risk. However, each event also serves as a reminder that stability requires continuous vigilance. Perhaps the most powerful lesson from studying financial vulnerability is realizing how interconnected modern life has become. A moment of uncertainty in one corner of the financial world can ripple across industries, communities, and households far beyond its origin. Stability is not simply built through policy or technology. It is sustained through cooperation, transparency, and shared confidence in the systems that support global economic activity. The idea that a brief window of time could challenge the entire financial system is both unsettling and fascinating. It highlights the extraordinary complexity of modern finance and the responsibility carried by institutions that operate within it. More importantly, it reminds us that behind every transaction, investment, and economic decision lies a collective belief in stability and progress. If you found this exploration thought-provoking and want to dive deeper into the hidden forces shaping global finance, take a moment to like this video and subscribe to the channel for more in-depth stories and analysis. Share your thoughts in the comments. Do you believe the global financial system is stronger than ever? Or do you think unseen vulnerabilities still exist beneath the surface? Your perspective adds to the conversation, and it helps shape future discussions.